Hello, I'm Jack Brooks. I'm the Executive Director of the Mid-Atlantic United Methodist Foundation. Thanks for joining this call about the markets from the past year and a little bit of a view ahead. I have with me Keith Aliardi. He's the Chief Investment Officer of Fulton Financial, and he's going to go over a few things with you and some viewpoints. First, I want to thank everybody for your commitment to the Mid-Atlantic United Methodist Foundation. Last year, we grew by 30 new church relationships. So our ministry advances as your ministry advances. We also were able to distribute millions of dollars last year for ministry and mission to the churches that are participating with us. I think it was a record year, and we'll hear more from Keith about that. So let me introduce Keith Aliardi, Chairman of Fulton Financial's investment arm.
Thanks, Jack, and good afternoon, everyone. Jack, Happy New Year, and thanks for inviting me on the call this afternoon. I am going to share my screen here, and hopefully that is coming through clearly. And let me just dive in. So 2022, we have identified as a year of transition, and after a 2-year battle with the COVID pandemic, massive stimulus, both in terms of fiscal and monetary policy, a rebound and recovery in the economy and the equity markets, 2022 is shaping up to be a transition year. So what I thought I would do is just very quickly recap what we experienced towards the tail end of 2021, look at our economic forecast for 2022, as well as the risks and the cause of transition for 2022, and then ultimately our forecast for the markets going forward. So with that outline, let me first share a recap of the end of 2021. So clearly, COVID and the Omicron variant had an impact to the tail end of 2021. What we have on our screen is some real-time economic data going in through the fourth quarter, which ultimately ended up the fourth quarter GDP up around 6% or so. Full year 2021 came in right around 5.6, 5.7%. So ultimately, 2021 was a very strong year for the economy, and that played out in the equity markets in particular. So working our way left to right on this chart, beginning with municipal bonds and fixed income and ending with emerging market equities, you can see predominantly starting right in the middle, U.S. large cap value equities for the full year 2021, as represented by the blue bars, was an enormously positive year. U.S. large cap value up almost 25%, U.S. large cap growth up a little over 32%, international equities 11, et cetera. Master limited partnerships and REITs had record years at 45, almost 46%, and almost 29% respectively. Really strong story for equities in 2021. Fixed income in a rising rate environment that we started to see in the second half of the year was much more challenged. Municipal bonds up about 1%, U.S. fixed income down about 1.5%. Really, the only thing that worked in 2021 in fixed income was anything that had a inflation-oriented profile, and that included TIPS, hedge funds, and high yield. But a very successful year for 2021. Now, looking out to 2022, as I said, our primary theme is a transition year. And here's what that looks like. For starters, we start to see growth normalize, somewhere in the range of 3.5% to 4%, as emergency fiscal policy from the pandemic starts to wane. 3.5% to 4% is still really strong growth. feels a little different than maybe the mid fives that we saw in 2021, but still really solid growth. And if you look out past the past decade or so, we've averaged somewhere between less than 2%. So we still are looking for a really solid year in 2022. Employment, we should see maximum employment by the third quarter of this year. And the real big issue that we have seen through most of last year, and likely in the first half of this year, but we will begin to see supply and demand imbalances start to moderate. Slower demand for durable goods should normalize along with supply chains. That should help inflation, at least a little bit. We should see inflation ease from the 7% rate that we saw at the end of last year to somewhere between 4 and 4.5% as those supply shock issues begin to be resolved. However, we will experience what we call active monetary policy, or the Federal Reserve beginning to normalize rates and increase their short-term interest rate. That could equate to somewhere between 3 and 4 rate hikes in 2022. Even so, we expect good earnings, even though valuations are slightly stretched. Earnings per share growth in U.S. companies should average about 8%. The equity markets, particularly developed markets, stand to benefit from the continued economic expansion. And we should see equity markets somewhere in the range of returns between 6 and 8% for 2022. I've averaged it out to be about 7% from these levels. Fixed income will be challenged. I will talk a little bit about that, but we should see fair value of U.S. Treasuries on 10-year U.S. Treasuries about 2.25%. That's up substantially from the 1.5% that we were middle of last year. So let's talk a little bit about where we are right now. And clearly, we experienced the slowdown from the Omicron variant starting around Thanksgiving and rolling into middle to end of January of this year. We use this index. It's referred to it's the Moody's Analytics and CNN Back to Normal Index. As you can see, the real substantial decline right around the holidays. And we've seen some recovery. We gave a little bit of that back. But we've had real trouble to getting above around 95% back to normal, as you can see if you look back over the history of this index. But we're starting to see a little bit more improvement as infection rates start to peak, as hospitalizations start to peak. And I would expect us to see some normalization in this index as well. That did carry over into current activities in the economy. We used the current activity index. We saw a larger drag than expected in the end of last year. Manufacturing fell, housing was okay, personal spending declined a little bit, and jobless claims increased slightly. As you can see, U.S. claims, the last reading up 286,000. Continuing unemployment claims up slightly to about 1.6 million, although our unemployment rate today is at 3.9%. That shifts us into 2022. So because we saw the slowdown in the last month of last year and into this year, we've had a really, really volatile market for the start of 2022. So this chart almost looks like a mirror opposite or a reflection of what we saw for 2021. Fixed income down on the far left-hand side, U.S. fixed income down about 2%. In the middle, U.S. large cap growth stocks, those are mostly technology stocks, have really been hit hard, almost about 10% or so. Value stocks down almost 6%. Really right now, the only thing that in the first month of the year, the only thing that was really working was master limited partnerships, MLPs, or the energy sector of the market. This shouldn't come to any surprise. Again, we're going into and have gone into a transition year, and transition years are certainly volatile. But I pulled out this handy chart because I think it's helpful to take a look at history of and what transpires every year in the market. So this chart, as titled, are the annual returns and intra-year declines in the market looking out over the past 42 years. The red dots represent a decline in the lowest decline in the market in that year. The gray bars represent the year-end value, or how those years finished. So number one, despite the average inter-year drop of 14%, the markets have finished positive 32 of the last 42 years. Even we sit at around down 10%, about 7% this year in the S&P 500. Last year we were down at 1.5% and still ended up at up 27%, as referenced by the far right bars. So it's a good reminder that the markets are volatile. They can decline in value, but historically they end up positive for the year. So here are the key points today, based off of the start of the year. My key points today are that the economic growth that we expect should carry us through the risk of the slowdown in Omicron and really other variants that might be floating out there, but bigger concerns about inflation and higher interest rates. I think higher rates, which we expect, won't derail the equity markets this year. And lastly, the recent correction that we've seen has created some opportunities in undervalued parts of the market. So let's take a look at a couple of those real quickly. First of all, looking out to 2022, we expect, as I said, somewhere between 3.5% and 4% on the far right side growth for 2022. Estimates for the first quarter 2022 are slightly above 3%. So we have that tailwind that we're coming off of the end of last year, but we expect to see the pace of growth accelerate throughout the year. That's favorable for stocks. Of course, the biggest risk, as I highlighted up front, is inflation. 7% U.S. inflation rate in the last reading at the end of last year. In the headline number, 5.5% in U.S. core inflation in December of last year. This has changed the trajectory of the Federal Reserve. The Fed has gone on record up till the end of last year of being willing to be patient towards inflation and not raising rates. You can see back in September on the left-hand side, September of 2020, there was no expectation of rates. Really, through March of 2021, no expectation of rates. You can see that blue line flat all the way along the bottom of that chart. June, things started to change as inflation began to heat up. All of a sudden, we were looking at perhaps one rate in 2022 and really lift off in 2023. Even September, maybe a rate or two hike and really lift off in 2023. By the end of the year, that obviously has changed. You can see that black line sloping severely upwards, meaning the Fed has gotten really, really aggressive in terms of raising rates. And their expectations for inflation on the right-hand side has changed pretty dramatically too. Now, though, still, as we said, we should see some easing through this year. But the concern for the market is what does a rising rate environment do to stocks? Well, if you look again at history, it's not as bad maybe as investors think. This chart addresses every rate hike we've experienced back since 1983. At least this is where the date of the start of a rate hike cycle, going back to 1983. And you can see, if you start at the bottom, the next 3 months, the market was up 50% of the time. Over the next 6 months, however, the market was up 75% of the time. And really, the only two times it was negative was down 0.7% and 2.5%. By 12 months out through the start of a rate cycle, the market has been up every single time. So we look at that as opportunistic. We look at that as a rate increase could create volatility, it historically has created positive returns in the market looking out 12 months. And that, quite frankly, is because usually in a rate increase cycle, it's because the economy is doing really well. And again, we should see a strong economy this year. As I said, that creates some opportunity, and this most recent decrease in the market has created some opportunity. Valuations have come down pretty substantially. As you can see, that arrow pointing to the dot, that was at the end of January. Valuations have improved even a little bit more. In other words, this may be a buying opportunity for cash that's available. In terms of fixed income, I grabbed the same chart because the story is sort of the same. This is, again, red dots are intraday or intra-year declines. Gray bars are year-end returns in fixed income as measured by the Bloomberg US Ag. As you can see, actually, fixed income is negative really every year back from 1980, but generally finishes positive. No, I think fixed income is challenged this year, but the probability of a positive year when you look back in history is pretty good. And I think that more importantly, when you combine fixed income with equities, long term you get a better result because fixed income should shield you from any major disruptions in the equity markets. But with equity and fixed income in a transition year, we look at what the expectations are for returns throughout the year. We run our capital markets assumptions in the beginning of the year. That's what these are. We look at each investment objective going from fixed income to equities, and we put ranges of returns based off of those allocations of stocks and bonds. In this case, if you look at the average, let's take the growth portfolio, that would be a 65-35 portfolio. Our expectations that on average, you should see about a 6.5 or expect about a 6.5% return in a 65-35 portfolio based off our assumptions this year. Now, we could see a return up to 27%. We could see a decline of down 11%. But we think on average a 6.5% return is highly probable and has the greatest statistical value. You can see what those other return expectations, we use this to help investors narrow in on a specific investment objective to meet their expectations of return and risk. By the way, this has shifted down a little bit, about 0.5% or so from the expectations of last year. So let me, with that, on that 6.5%, we continually look to take advantage of opportunities within the market. So within our positioning right now, we continue to emphasize equity portfolios. We favor growth over value, but we continue to tighten our spread between the growth part of the growth part of the market and the value part of the market. We're underweight international, but we're keeping an eye on it. We'd like to see more credit in fixed income and certainly favor shorter durations and leveraged loans where possible that are less interest rate sensitive. And those investors that use alternatives, we're using that as a hedge against inflation and market valuations. So how are we positioned? We remain overweight in U.S. equities. We remain underweight in international. As I said, we continue to shift some of the U.S. large cap equity portfolio from blend and growth to large value. We have been de-emphasizing mid cap growth We've been increasing our small value, and again, look at core credit and alternate and floating rate in fixed income. So let me summarize, Jack, with this. I think current economic measures have slowed a little bit, certainly out of the fourth quarter, but we don't think it's enough to reduce our outlook for the current year. Inflation's the key theme to 2022. I think labor shortage, supply chains, demand should gradually normalize. That should stabilize inflation into the second half of this year, supporting at least 3 interest rate increases by the Fed. I think under that scenario, equities can advance from here. Bonds will have some challenges, but I think are always necessary in a balanced portfolio. And we continue to make tactical changes to adapt to the transitions that we expect this year. So, Jack, I'll stop sharing and happy to ask there any questions or turn it back over to you.
Thank you very much, Keith, for the presentation. If you tune into any TV program, you see a lot of doom and gloom and what's going to happen, and that changes daily. We like to take the long view because mostly church assets are a very long-term investment for churches. We do encourage everybody to take a look at your asset allocation based on what your current needs are. To review that, we recently sent the performance report to each one of our clients. There's over 400 clients. We've sent over 400 individualized performance reports to you. How you experience the markets is really driven by your asset allocation, when you add additional monies, or when you take withdrawals. All of those impact your individual performance. Keith is giving us the great overview about what's happening with the markets and a little bit of the look ahead. We also have websites that you can see this information. You'll find that on our main website. This recording is up there, and a lot of valuable ideas about what is happening in today's church world, stewardship world. We have a planned giving website because that's perhaps one of the largest growths that we experienced last year. We have experienced growth, and as Keith has said, the markets did very, very well over the last few years, and people, investors, donors like you are sharing with their churches. We have seen an increase in giving in many churches and a large increase in multi-million-dollar gifts in planned gifts or planned giving. People planning for what's going to happen to their church in generosity. There is still a way you can participate with our education programs. We have a number of different programs around selling a parsonage if your church is considering that. We also have about cemetery management. And of course, planned giving, one of a whole website that we have dedicated to those items. So I think with a year ahead, it's time for a year of planning. Don't hesitate to call the foundation or reach out to us and let some of our team members get involved with your specific church and your questions for where your ministry is established. We look forward to a year ahead for you. And I want to thank again Keith Aliardi for joining us today on all the valuable wisdom about the markets past, present, and of course, a bright future. Thank you again for joining the Mid-Atlantic Foundation. We'll see you again soon.